I just want to get into the little semi advanced option stuff. So right now we're in spreads. We're no longer in basic anymore. Remember what I told you about the credit spread and the debit spread. But right now we are going to do, you have a call spread and you have a put spread, okay? When you get in here, it doesn't matter which one you pick. You can pick credit spread, call spread, put spread. There's calendar spread, ratio spreads. I'm going to make a video for that later on. But right now, let's just say we're going to do a put spread because that's the one I covered in the video. Okay. So go to it. Now, put spread, basically, like I said, it's purchasing a put with a higher strike price than the written put. Okay. Well, they're considering this a debit spread. So it's not a credit spread strategy. But anyways, you can still change as long as you select the strike price that's more expensive than the out of the money put, okay? So, and the out of the money put should be cheaper, and that would make it a credit spread, okay? So, and just to clear your head, let's just go back. Let's just do credit spread here. So that way, you see our credit spread is a two-option strategy that results in an initial credit to the trader. It can be used in both a bullish and bearish market, depending on configuration. Okay? So, we're going to go to AMC. Yeah, okay. I need to type it. Sorry about that. All right. And so, we're going to pick our long option. First, let's pick our short option so it clears your head and it's more easier to understand. So, we're going to write this option. Remember, we're writing the option. We're selling it to the option buyer. We're selling the put option, okay? That's what we're doing, okay? So we're going to write, see this one, the short option? We're going to write that option, all right? We're going to try, let's say, let's try July 16th because it's still underneath 90 days, right? We are going to select an option that's a put. So anything that's shaded gray, that means it is out of the money, okay? And anything that's not shaded and it's white, that means it's in the money. All right. So we're on the put side. We're on the right side. OK. We are going to write. Let's say we want to collect a lot of premium. OK. Let's say we're expecting AMC to go up. Remember, a put credit spread is a bullish strategy. We're expecting our put to become worthless. OK. So we're going to pick a short put at 65, okay? So I'm going to hit the bid here, just like I would in TD Ameritrade. I'm going to hit the bid here at 65 for $2,100. So that's going to be $2,100. And as you can see, the total cost, if it's a little bit shaded, but it's $2,100, okay? At the 65 put. I'm writing that put. So that means I make money when that put becomes more worthless. I'm running out of battery here. I'm making more money when that put becomes worthless. So I'm receiving $2,100 from the buyer. So it says here, right now the spread price is 21 credits. So if I were to calculate this, I mean, it'd be a naked. Well, I have to complete the fields. That's why. Yeah, I can't do that. I wish I could, so I could show you. It'd be a little better example. But I'm receiving $2,100, okay? Now, I'm going to buy a put option, long put option. See, it says long option. I'm buying. With that $2,100 that I just received, I'm also going to buy a put option. So we're going to go here. We shorted it in the money, so put option. So I'm at the risk of that getting exercised and the put buyer saying, hey, I want to exercise my option and get negative 100 shares. Now, if he decides to say, hey, I want my negative 100 shares, I'm going to receive positive 100 shares. I have to pay for that option because it's, but we'll get to that in another video. But in the meantime, we shorted that 65 put, which is $2,100. And let's say I want to keep a lot of that credit. So I'm going to buy a $30 put right here on the upper right side. It's gonna go, so I'm going to hit the bid. Remember, I'm going to hit the mid or the ask. So I'm going to hit the ask out. So I'm going to pay $190, okay? $190. So I get executed. Okay, so price per option, 190. It's got to cost me 190, but the total cost on that short option with the total premium I'm keeping is $2,100. So I'm receiving a net credit. You see, I'm receiving a net credit, not a debit, a net credit. That means $1,910 I'm receiving. Okay, so if you calculate that, I'm receiving $1,910. Okay, it's a bullish strategy. So that means if AMC decides to go up, okay, see the probability of profit is 63%. If AMC decides to go up from $59, if it goes up in one day, I'm not going to make that much because IV is going to go up because it's a fast move. I'd rather get a call option instead. But the longer time passes, time decay is eating at that shorted put, okay? And there's a bullish strategy. So that shorted put, right? The put buyer is losing money, right? On that shorted put that I got because his put is going up in direction. So he's losing money on that put. And I'm making money because he's losing money, okay? Remember, options is a zero-sum game, all right? I'm on the other end. I'm the house. So I'm making money when he's losing money. And I'm also, if, let's say, remember, he bought the put option, so you need to be correct. If you're buying the put option and you're long and you're that put buyer, you need to be correct immediately. You see, if it's the first day and it's June 20th and the option goes down completely straight down, I'm losing $166. And that person's gaining $166. But remember, you see, I'm not even losing that much because it's underneath 30 to 90 days. I'm not losing that much, okay? That this is a lottery ticket option. That's why I say get the lottery tickets that are underneath 90 days if you're shorting. Because if you're the buyer, you're screwed. If you're the buyer of that put option, right? Or you're the buyer of that vertical, right? And AMC decides to drop that, let's say it tries to drop down, you're only going to gain 156, but every single day you're losing. Meanwhile, a person like me that has this shorted put option, every single day it just stays in that range. That's why I tell you to dip buy while it's high implied volatility, because you keep more of the premium at the end, okay? You keep the full premium at the end. That's what you want. You want the full premium, all right? You don't want, you want to keep that whole premium while it's expensive. But while it's not expensive, you don't want to get a cheap premium, okay? So every day that AMC stays the same or goes up, even if it goes down, look at that. As time passes, even if it goes down, right? Yeah, you're not going to make as much, but the more time passes, the more you still make gains. As long as, oh my God, I'm losing connection here. Okay, here we go. As long as time passes and as long as time passes and you're correct on day one, it gets easier and easier and easier and easier because time passes. It's the complete inverse of getting a debit vertical put spread, okay? A debit vertical put spread. It's the inverse. If we were to go and flip this, let's say we were to buy this 65 put, okay? We were to buy this 65 put. So we're going to hit, let's say, actually, it's better for me to just do it this way. Let's just say I buy that, okay? And I write that, okay? Well, hold on. I write that instead, all right? Just to make it quick. Look how inverse that is. I have to have, remember, basically what happened was I bought a put that was extremely expensive and I shorted, basically I bought a more expensive put and I only shorted out of the money to make it a little bit cheaper on me. So my downside gain is not going to be that much, but my upside risk is tremendous. And every single day that passes, I'm losing money. This is a debit spread. You don't want to be in that scenario. Debit spreads are not good only on expensive stocks, but I'll explain that some other time. But you see, it's the inverse, okay? It's the complete inverse. It says net credit, but that's because I put it on a short option. If I were to actually change this, let's say I were to change this, let me, how do I go back here? Go back to home. And let's say I were to do the put spread again, right? See, and now we're to do AMC, right? And let's say it will say debit this time. If I go and I write this out of the money, right? And I go and I buy a more expensive put that's in the money. See? Net debit. Net debit. That means I'm paying, okay? And look how horrible that is. This is an even cheaper, this option is expiring a lot quicker. Look how fast you need to be right in one direction. Remember, this is a long strategy, okay? You're long the put and you're just short a little bit, all right? Now I'm going to do the same thing, just with a simple vanilla call and a vanilla put. I'm going to show you the difference. Now, let's actually do a long put, right? Sorry, a long call versus, actually, I'm just a little confusing. Let's say, let's compare a long call, which is a bullish strategy. You see it's bullish, compared to a naked put, okay, on AMC right now. All right, so let's start off with the long call. All right, we're going to compare a lottery ticket option that's expiring within 30 days from now. Okay, so the lottery ticket option, are you better off buying the call or are you better off shorting the call? Okay, so if we go and we buy a lottery ticket option, let's say June 25th, this week, we buy a call option that's way out of the money, like the 145s, right? No, let's just say, because most people pick the 145s. I mean, it's your chance of you winning. Let's just look at that one. Just chances of you winning. You pay 135. AMC has to move quickly. So day one, if it doesn't even get to $64 by tomorrow, all right, you're only gonna make $16. If you hold to the next day and it still ain't above $64, you just lost $6 or even $33 or $55 if it goes down, or $74 really quickly. You can see, and every day, let's say 2 days pass and we're at like 55 or 40, you have a lot of hole, you have a bigger hole to dig yourself out of just to get to break even quickly. Look how much it jumps. You know, let's say we're still at 61 by June 24th. That's why I tell you my strategy is I never let it see Wednesday, because by Wednesday, look at the break even. You have a lot to dig yourself out of. I'd rather be at the end of Tuesday. I'd rather be out. I'd rather be gone. I don't want to be in that option. There's no point in being there. If it ain't gonna go up, get out. You know what I mean? That's my opinion. If the IV increases, let's say we increase the IV on this, you know, because I'm playing those lottery tickets. Remember, for IV, if IV was to go to 600%, look at it now. Look at that now for that call option. You see that? Now my break evens are a lot lower, and I made more money, and I made substantial amount of money. Even though the direction didn't go up, the options are a lot more expensive anyway, because implied volatility increased, because I have Vega on my side. Okay, that Greek Vega. All right, so I'm gonna make money from implied volatility increasing. But that's how you play those call options. There are lottery tickets. You're playing it for the Vega. You're not playing it for the Delta, because if you play for the Delta, you are going to be screwed. As you can see here, you're going to be screwed. Look at that, 400. You're already losing money. And that's remember, that was the implied volatility when it was like 450. I just lowered the implied volatility. You can see that. That's horrible, if you were to jump in. So that's a call option. Now let's do the reverse. All right. We're going to go back and we're going to hit naked put, which is still a bullish strategy, okay? AMC, all right? AMC dips, implied volatility is high. Let's say, so we're going to get the same thing, all right? We are going to get the call option, but let's just say we get the 145s, the same one. Let's say let's say we shorted a put instead. We're not going to buy, we're going to short a put that is, let's see here. We're short a put that's out of the money. So anything in the gray on the right side. So we're going to short something. Let's say I think AMC is not going to go any lower than 48. So I'm going to buy the 48 put option, which is on the right column. I'm going to short it. So I'm going to hit 955 on the bid because I want to get executed quickly. Okay? Right? So now it says total cost, but I'm writing it. Okay? If I calculate that, look how much that changes. And I only got a couple more days. Well, hold on. I didn't pick the right expiration date. So let's just say June 25th. All right. Let's say, I know this ain't going to get any lower than 48. So it's $256. Okay. Look at that. Now, this is $256 on an implied IV, on an IV that's $279. Okay. So you can see, as long as AMC stays where it's at until expiration, I'm good. As long as day one, I don't lose money. As long as it doesn't go down on day one or day two or day three. Look at the break evens, how they're dropping. Okay? Now, what if the IV increased? What if I didn't do it right now? What if IV was extremely, what if we spiked and then we pull back on high IV still? The IV is still high. Let's say it was at 500, right? 500 IV, right? Okay, this is calculations a little messed up here. Hold on. Let me make sure. Okay, 500 IV. Why is it not doing that? I don't know why. Okay, it's automatic. All right, if I were to change this to 500 IV, 1 second. Well, I think the reason is because I already put it in, and then when I raise the IV, it kind of ruins the gains that I make because the IV increased. But remember, if you get in and you short that, if you short that put and the IV increases on you, you lose money also, but you'll eventually gain it right back as long as it doesn't go, in the money. As soon as you start going in the money on that put option, you start losing it. So, so you see the downside risk when it starts to go down. The put starts to become in the money. You don't want that, but let's go back to, let's just leave it where it is. Let's just say auto, okay? But you can see you make money as long as it stays where it's at, or even if it goes down, okay? On the 25th, I would have been out of that. I wouldn't let it expire. Even if I was, let's say if it was underneath, the put was in the money, it was 58 and it was close to expiration, I would have got out with that $540. I wouldn't let the person, the put option buyer, exercise on me, But even if he did, and I was short the put option, right? He gives up. Remember, when you exercise, if you're the long put buyer and you exercise the call option, if you exercise the put option, you give up that $535 or $508, okay? Gain, let's just say. Well, sorry, even a loss. You give up the premium in order to exercise the option. Because remember, you're paying for the strike price. You're not paying for the premium. You're not trying to receive the premium. So you still keep that $508, but you're obligated to buy 100 shares at, let's just say, I got the 50. I basically got the 59 put. So that means I have to pay 100 shares at 59. But I don't want to get exercised. I want to take the money and run. Okay? So now you understand the difference between short calls, short puts, short verticals, and long puts and long calls. Okay? Always remember, credit, you're receiving the money. Okay? You're getting the money and you're trying to make it worthless. You're trying to make sure the option is worthless so you don't have to pay back anything and you collect a profit, okay? Just like short selling, okay? It's just like shorting stock, okay? You're borrowing the stock at a certain price and it keeps its value. Let's say you shorted at 43. Now it's down to $10. You have a lot less to pay back because now it's a lot worthless, that stock. So when you give back, when you give it back, you're basically paying a lot less. So when you buy to cover, just like hedge funds are doing, they're buying to cover on AMC. They shorted it at let's say $20, right, at the peak, and AMC went down to $5. They could have bought to cover right there and closed their position out, and they wouldn't have to pay that much. They would have been at a profit because they had to pay a lot less. But now AMC is at $60, so now they owe a whole bunch more than what they borrowed, okay? Because AMC is more valuable, so they have to pay more than what they borrowed, okay? Now, if you buy an option, it's a debit. You're paying, okay? So you're paying for the option. So, and when you sell it, you basically, you're paying for the option. Let's say you pay $40, right? And now it's worth more than that. Okay, you pay a debit of $40, right? Now let's say the option's $80, right? Or let's just say the price is $80, right? Now it's more valuable. So now you receive a credit. You receive a credit of $80. So since you receive a credit of $80 minus the $40 debit that you paid, you have a net profit of $40. All right. Thank you. Have a nice day.